Hey everyone, welcome back to the show. I am so thrilled today to be here with my friend Jaclyn Johnson. We're recording live here in Manhattan. And honestly, I couldn't think of a better person to kick off our series on converting revenue to returns. These are conversations with entrepreneurs on how they're investing the money that their business is generating outside of their business, so into different asset classes to multiply their money. It's the whole concept of your money making money for you. So, Jaclyn, welcome.
I'm so excited to be here.
So excited to have you. For those of you who don't know Jaclyn, the very few, I should say, who don't know who Jaclyn is,
I love that.
She is a serial entrepreneur with $25 million in successful exits to her name. Best known for founding Create Cultivate, the largest media and events company for ambitious women. Jaclyn is currently the CEO and co-founder of Cherub, a platform that matches angel investors with founders, which is very timely for a conversation today because it's all around angel investing. I actually am an angel investor in Cherub, which I'm so proud of. They are such an incredible company. You hear more about that today. But Jaclyn herself is a prolific angel investor, which is why I knew we had to bring her back to the show to cover angel investing as her chosen money multiplier. So normally, I know those of you who tune into the show regularly, we start out with what's your Cubicle to CEO story. But because Jaclyn has actually been on our show before, I'm actually going to link below her previous episode. So if you want to catch up on her background, her origin story, if you will, then go check out the episode linked below after you tune into this one. But we're just going to jump straight into angel investing,
Let's
Jaclyn.
do it.
I feel like it would be helpful for our listeners to get a little bit of context into what angel investing is, because I feel like there's still a lot of people out there who are like, what the heck does that even mean?
Totally. So angel investing is when you're investing in companies in the private market. So these are companies that have not IPO'd, they have not sold, anything like that. And you can invest in private markets on the earlier side or the later side. Angel investing typically is on the earlier side. And I think there's confusion because sometimes people think angel investors are just giving you money because they like you and your business. But the reality is they're actually expecting a return. They're just not as aggressive as a VC is, who is basically going to demand a return for their money. So angel investing is when you find a company. It could be really any category: beauty, fashion, AI, tech, hospitality, whatever it might be. And you invest, an increment. And I would say angel investing typically is in the 10 to 20K range. It can be upwards to 250 to 500K, depending on where you're at. But typically that's a family office and a little bit of a different ballgame. But you can invest as low as thousands of dollars into a company.
Yeah, no, it's true. I think my lowest angel investment ever was like 2,000.
Yeah.
And for transparency, my highest was 50,000.
Yes.
So
Yes,
cash,
exactly.
at least. There's like some others where I negotiated other deals.
Sweat
but
equity and stuff like
yeah,
that. Yeah. I love it.
But I think it's such an interesting concept that actually I think a lot of people like you who are listening to this, if you're not super familiar with the concept, you may have actually in like a roundabout way seen this happen through like things like Shark Tank. I mean, they're a form of angel investing.
Absolutely.
And so I would love to kind of give our listeners an overview of your actual angel portfolio because you've invested in 18 companies, right? And 2 of these have exited. We'll get to that in just a moment, but let's first kind of like discuss your investing thesis. I'm really curious because I was like looking through your portfolio and I'm like, what's the exact, the rhyme and reason here? So like, first of all, what draws you to a company initially? Is it the founder or is it the product?
It's pretty much always the founder, I would say. And I think my thesis has really evolved and changed over time. When I first started angel investing, which was like a really long time ago, so like 2010, 2011, it was really in founders I knew who had great ideas. So I was very early. And because I was building Create and Cultivate, that was primarily female founders that were early stage. So a good example, Jen Rubio from Away Luggage. Then you have Diana Cohen from Crown Affair. And these were checks written in the earliest days of these companies, like genuinely when they're like, I think I'm going to launch a business. So those were the checks I typically wrote. Now it's changed a little bit. I would say I typically invest in a little bit further along companies, something that I believe in, but I also still double down on some of the earliest founders in categories, specifically what I'm focused on now, categories that I'm not over-indexed in. So I'm very over-indexed in beauty, skincare, things of that nature. So I'm really trying to move into different categories and usually with a tech bent.
Okay, I was actually going to say, I noticed when I was like, again, scanning through your portfolio, there was a lot of hair care brands and whatnot. Do you find, I mean, you said you're not really investing heavily in those categories now because you're already pretty saturated. But before, when you were like, let's say you had invested in Crown Affair already or Ceremonia, and then, Ali Webb came out with Messy, what factors do you consider when you're angel investing in a company that is similar, maybe not exactly the same type of product, but similar to ones you've already invested in? Is that a negative or is that a positive?
It kind of depends, but I think you're essentially hedging bets in a way, because at the end of the day, there is going to be a massive sweep of mergers, acquisitions in the hair care space. Like, we've already started to see it. Like, I would say, like, the first one was Way, Jen Atkins brand, which was acquired, I think, at $50 million in revenue, which isn't super high. So people are starting to sweep up different brands. The way I look at the portfolio mix is Crown Affair is luxury in a way, or prestige. Like, it is a category that none of those other players play in. Like, they're going after the Kerastoses. They're going after a market that no one has really disrupted in a big way. So that is like my luxury prestige play when it comes to hair care.
Right.
Then there's Ceremonia, which was really focused on textured, curly hair, specifically the Latinx market, which hadn't been really marketed to.
Yeah.
So there was this specific kind of niche they were going after. They've since expanded and kind of gone a little bit wider, but that really was a play there. And then Messy and Allie is really a bet on Allie in a lot of different ways. She's been there. She's done that. She's a good friend. She's also an investor in Cherub. And so obviously I'm supporting her in her vision. But the products are actually really interesting as well. She's doing a lot around innovation, and she's really focused on the health of the hair, which is ironic because she started Dry Bar, which is all about heat processing your hair essentially. And so after years of doing that, she really has gone back to like, how do I create a product that like lets your hair live and breathe its healthiest life, and maybe is like a little on the messy side, like the air dry cream is her big one. But I think at the end of the day, that's a big bet into Allie as well.
Right. No. And it makes sense too, given the type of work that your background is in with Create and Cultivate. You've met thousands of founders. And so your network is really robust for that type of deal flow. And you even said some of your earliest angel investments were just from direct friendships and relationships you already had. These days, would you say a majority of your deal flow still comes from your network, or is it cold intros?
It's more like, it's actually like mostly through Cherub now, which is so interesting, but it's not people, it's people I've met through Cherub, not people I've known previously.
Gotcha.
Which is really exciting. So I think that was something that like really opened my eyes in a big way, was like looking at these companies outside of just my scope. I also think like now where I am in my age and in just the life cycle of businesses, most of these businesses I've invested in have now been around almost 5+ years, right? So a lot of the people that were my peers and people that were building, we were like starting around the same time. So now they're in this like midlife journey of their businesses, whereas the youngins are starting their businesses. And so I have to get in on those companies as well.
Yeah. And when you say early stage, because you specialize in early stage investing, what do you consider early stage? Is it based on revenue milestone, or is it based on years in business, or a combo of both? And can you clarify what you're looking for in that stage?
Yeah. So most of the investments I have made, or I would say like at least half, were idea stage, hadn't even launched yet. So pre-product, pre-revenue. So that's Away, that's Crown Affair. I believe Liv Tintin hadn't launched yet, but the idea was there. So I was early in a lot of those brands. Now I would say it's typically post-product, post-launch. Revenue for me isn't as, I just need indicators. I need product market fit. I need people interested. I don't care if you're monetizing quite yet, but is your email list there? Are people joining? Are people sticking around? Like, that type of thing is more interesting to me than anything else.
And what kind of fuels that confidence, especially when you're, let's say, investing in someone you don't have an existing relationship with, they don't have a proven track record of success. If you're looking just at these indicators, what makes you bite the bullet and say, okay, I believe this one is going to be a success versus another one that maybe even shows some early revenue? Like, how do you differentiate or discern that?
It's really the founder and the grit around it. Like, do they have what it takes to build and sell this company? And like, I feel like I'm really good at identifying that. But also, is there a market for this to actually sell one day? I think that's like a big thing as well. Because I get pitched a lot of companies where I'm like, who buys this at the end of the day? And if it's hard for you to answer that question, it's a far riskier investment. Whereas if you're like, specifically with like food and beverage or whatever, you're like Unilever, L'Oreal, like there's a million buyers for those products and they're actively buying, it becomes a less riskier investment.
Okay, that makes a lot of sense. Can you give an example of a company that you angel invested in that maybe doesn't have such a wide breadth of potential buyers? Like you mentioned in beauty and food and beverage, there's a lot,
Yeah.
there's a plethora. But is there one where it was a little bit of a riskier category where you're like, okay, there are buyers that exist for this, but it's not going to be as obvious, and share with us like what that decision process looked like?
Most, I would say, have specific buyers. There's one that was like not random, but like there's a company called Renati, and their goal was to bring the antiques world online, essentially. So create a marketplace. So not like first dibs necessarily, but really like a B2B marketplace where they could sell their products through others. So think like Fair. I don't know if you know Fair, that company, but it was like any company could go on and get like pushed into retail. So it was kind of like that for antiques. It was one I wasn't as familiar with the market with, but I really liked the founder. I really believed in the vision. I had friends that also had invested in it, so there was like a lot of momentum around it, and I co-invested with a friend into that one. Again, I'm like, I don't know who necessarily buys that company, but I did think like that was a problem that needed to be solved, especially for these international European antique dealers that just like have no idea what the internet is, but have like amazing products.
Right.
So I was like, there is like a problem to be solved there. Who buys it? I'm not sure.
Okay. No, that makes complete sense. So it's like more about, is there an active problem that needs
to
solved?
be solved? Yeah.
Right. That makes sense. For the timeline, you did mention at the beginning, angel investors are looking for a return, but they're not looking for maybe that 100x, 1000x return that venture capital firms are. For you, when you're trying to decide what to invest in, what are you realistically looking for as a return, both in terms of multiple, but also in terms of timeline? Like how long are you willing to wait before a founder exits?
Yeah, most exits are 5 to 10 years. So it's a long game. I think that's like something that's important to know. In terms of exits, I kind of treat it with like a VC mentality in the sense that I need one good exit to pay for all the other investments. So really like I think it's less like I need each one to make me a certain amount. It's more like if one hits, then it pays for everything else and it covers essentially my fund in what I get back. I don't look at this as like this is going to buy me a yacht one day, but I think if I can make any kind of return and support the entrepreneurial community in the process, like it's a win for me.
Yeah, that's fair. That's more than fair. And for two of your companies, they've already exited. So actually your track record's looking pretty good if you're looking at it from that, mentality. 2 out of 18 is like what, 1/9? I don't know what that converts to, but it's a good percentage. So for the 2 that exited, I would love to go into a little bit more detail for our listeners so that if they're kind of curious about angel investing, they can see what this might look like played out from, investment through exit. So let's talk about Away first, because that was one of your first investments. So you said you invested at the stage where it was just an idea. There was no product. There was no necessarily proof of concept. How long, well, first, what did you invest in the company? How long were you in it before they exited? And was this something that as they were approaching exit, you were pretty aware and like involved, or did it kind of just like come out of the blue?
Okay, so I invested, I want to say in 2012, I invested $10,000. And then basically I would say like I was pretty like, I was really good friends with the founders. Like they were involved in Create Cultivate, like things like that for the first couple of years. And then they like really exploded and they raised a lot of money. So at that point I was like not involved, I was not a key investor in the business, if you know what I mean, which is fine. And that happens, right? Like they went on to go build this like insanely big company. There was no like investor updates at that point, nothing like that anymore. And that also can be typical of larger companies, especially when they have boards and like hundreds of millions of dollars in VCs. Like the angels kind of get pushed to the wayside, which again is normal, which is a good thing. You're like, great, push me away if you're doing really well. 2019, I got a tender offer. So essentially that's a secondary. So basically what that means is there's a couple different ways you can exit as an angel investor. One, and the most like well-known one, is an IPO. So if you IPO, then your shares become way more valuable than when you're selling. So great, IPO, good exit. Then there's also an acquisition, right? So then you get bought out based on like the acquisition price. I mean, those can be very complicated transactions and you kind of figure it out based on that. That's great as well. The third is something called secondaries. And secondaries are when someone else wants to buy your shares to get more equity in the company. So maybe the founder doesn't want to give up any more of their equity. So they're like, go make an offer to our angel investors or some of our earlier investors and see if they want to be taken off the table. So this happened, and this was what I assume happened. My assumption was that they were planning to go public in 2020. Obviously, with COVID and travel and all that, that didn't happen.
Worst timing,
yeah. Rough timing. But I believe like VC firms and or some people on the cap table were like, we want more shares before they go public, obviously, because we see this as doing really well. So they made secondary offers to a lot of the angels on the cap table, which I took the secondary offer. So I was bought out of my shares.
Okay.
So I was bought out, and the offer was, again, on the share price was $1.2 million.
Wow.
Yeah.
So you invested $10,000 and you made back $1.2 million.
Yes.
Is that far beyond what you had hoped and expected
I
for?
thought it was
assuming?
$120,000. So when I was like trying to do the math on the back end, I was like, and so I called my lawyer and I had sent him the email and I was like, I think it's $120,000. And he was like, it's $1.2 million. And then the best part was I go, oh my God, do I take it? He was like, yes. Like, what do you mean? This is like an unprecedented return. And it is. It's a unicorn. It's like one of those that's not typical of angel investing.
Right.
But it can happen. Absolutely. And
Wow.
Poppy is a good example of that as well.
Yeah. I mean, I'm very, very curious to see how the early angels did on that deal.
They minted a lot of millionaires, she told me.
Really? Okay. And that's so exciting too as a founder, right? Like the people who believed in you early, like before you really had anything to prove, for them to share in those wins is much speed, like just such an accomplishment.
Yeah.
For you, the second one, then tell us about the second deal that has exited for you.
So Chill House was acquired by Kiss. So that deal was a private deal.
That's
they were
nail company,
acquired.
Right?
Yeah.
Okay,
So Chill House, and what I love about Cindy and like the story there is like they iterated. And I think it's a good example of like iterating can work in your favor and pivoting. They started as a brick and mortar concept with like multiple spa treatments. So nails was definitely one of them, but massage and I think facial for a little bit. And they had cafes and like all these things. Then they really like pivoted away from that and just started doing nails. Then COVID hit. So they did press-ons because obviously everyone was doing their nails at home. That exploded. Then they really like stepped away from like the spa experience into just nails, just press-ons. And then that press-on business exploded. Like Urban Outfitters picked them up. They were everywhere. And so Kiss, which is like the OG nail company, was like, oh, what is this brand that has a lot of velocity and a lot of interest and obviously an audience we're not getting? How do we kind of work with them? And so they did an acquisition of the company, which was great. And so the angel investors were bought out. That one was not a $1 million exit, but I definitely did like do very well and was able to make a profit.
That's great. And what was the amount that you originally invested? $10K. $10K too.
Yeah.
So is that like your typical check size that you're investing?
So I now am like a $5 to $10K check.
Okay.
I've lowered my amount because I want to do more investing. And I also sometimes negotiate in a pro rata, like because I can see if the company's doing well and on their next run, I can keep maintaining my shares and like my amount that I have. So it gives me a little bit of protection in a way because I'm able to kind of keep my equity alive. I also tend to invest in companies that will give me some kind of sweat equity, meaning I help them, I advise them, I post about them, I consult with the founder, whatever it might be as well.
I'm going to circle back to that in just a moment because I do notice a certain brand that you do a lot of, public facing work with, but the pro rata piece, can you break that down for us? Because that's new to me. So I want to better understand like what you mean by that.
Yeah. So a pro rata is when
To hear the rest of this episode and unlock weekly subscriber-only content and community access, join us as a premium subscriber at cubicletoceo.co/podcast. The link is below in our show notes.